Good morning, Mike. Welcome to Blue Notes, ANZ's newsroom. The result, first up, came in towards the top end of consensus. Is it a good result?
It's a great result. I'm very pleased with it. And I think it's good because of the quality. It's a very clean result. So a great start to the year.
And dividend was perhaps one of the strongest points there?
Yeah, I mean, the fact that that we've increased the dividend by 14%, is a great story. 83 cents is it's a nice number.
So what particularly pleased you? Was it the particular regions, productivity, credit quality?
Look, I think the bank was actually firing on all cylinders. I think you can say that across the piece it was going well. Most of the divisions have put in a really good performance in what has been not an easy environment as well. We had a pretty low growth environment in Australia. I guess if there was any area that was a little bit slow, and it's quite understandable why it was, is Insto Australia, particularly in the balance sheet side. But that was offset by growth in Asia for Insto. And if you look at the Insto business now, more than 50% of its business is now coming out of Asia.
And as far as taking that 50% of it's coming now from Asia, what about on the Australian side? Are there signs as the economy turns that's picking up at all?
Most of the companies are in very good shape. They've come through the crisis, the global financial crisis. They're cashed up. They got their balance sheets in shape. They reduced debt, and they're still in pretty good shape. They don't need to borrow.
One of the areas where the bank receives some scrutiny, and obviously there's a different business mix with Asia, but it's capital generation. Is that an issue for you?
No, I think the capital generation has been pretty good, and in fact the whole capital management is much better now. We try and allocate capital to where we get a decent return on it. The fact that we kept the ROE steady despite more regulatory capital requirements, despite pretty high risk asset growth, I think is a good result.
And when you extrapolate this result more broadly across the banking sector, for a while now, for several halves, the story has been that revenue gains are hard to come by. Cost control is a very big focus, and all the banks are taking a critical eye at that. And the bad debt story is very good, but the market doesn't seem to believe the bad debt story is sustainable. Is that still the general picture out there?
Oh, I think it is. It's the old adage that good loans are made in bad times, and we've had bad times for the last 5 or 6 years. So therefore, the book is actually still in pretty good shape, and I wouldn't expect there to be much stress in the book going forward for probably 2 or 3 more years. So I think we're in a pretty benign environment, and that will continue.
And the revenue side, there's obviously been pockets of good revenue growth in this one.
Yeah, no, I think revenue is the more difficult thing to judge going forward, because we are in a lower growth environment, particularly in Australia. However, that is offset to an extent by Asia, which is lower growth than it was, but it's still relatively high. So, I'm not too worried by that, but I think revenue is going to be the name of the game for the future. Australia and New Zealand both have done well. Australia, we've grown market share in mortgages and small business. The growth in small business, in SME business at 16% was really good. Where we have had sluggish growth is that corporate and institutional area in Australia. But otherwise, the growth in Australia has been pretty good. And we've grown above system in terms of deposits as well, which is encouraging. In New Zealand, the move to one brand has really been working. We've got a lot of productivity improvement out of that. The cost-income ratio is reduced by over 300 basis points, which is extraordinary. And of course, the issue there is that we're now beginning to build market share again, both in commercial and in retail. In terms of Asia, fantastic growth. A number of countries have got high digit growth. China 20%. Korea 45%. You know, these are really good results, and the growth there. And I think it's quite interesting because if you look at some of the international competitors, they've been seeing some of their business slow in Asia, and we haven't seen that. Margin compression has been there a little bit in terms of the trade, in terms of the trade business, but otherwise it's been pretty good.
And on the productivity side of that, Mike, with the hub strategy in Asia, how are the costs going? Again,
that's been a great story. I think our international hubs, you know, the hub structure that we have around the business is a real advantage for us. It gives us a unique flexibility. And I think that, again, we've managed to increase volumes by 8%, yet reduce operational costs by 4%. Now, that's a fantastic ratio.